All right, guys, so welcome to part two of our How to Broker Other People's Money class. Tonight, we're going to dive into the weeds a little bit. We're going to talk about some of the details behind what can be expected as far as loan terms go, the kind of things you need to learn from a borrower in order to pass a loan along to a capital partner and get that thing funded, and maybe just give you guys a little bit of a insight into how to think like a lender, because ultimately when you pass these things along to capital partners, not only do we only get paid if they close, but the quality of those loans, whether or not they are paid back successfully, will ultimately affect your reputation. So a little bit of thinking like a lender in order to be a successful broker. So get your notebooks ready. So part two of our brokering capital class. Like I mentioned, and like the last class, you're going to want to take notes. This one it's a lot of information. I will try to make it as entertaining as possible, but we basically just got to cover a lot of variables here. So it'll be a bunch of lists of info. And then at the end, of course, those of you here live are going to be able to ask me live questions. And for anybody watching this as a recording, you can reach out if anything is still confusing. But for best retention, we find that writing down the information, even if you're never going to read your notes, physically writing it down, not typing it, is the best way to retain information whenever you're studying or learning in a class like this. All right, so who are we? Who is Always Capital? We're a private lending fund and brokerage shop. We have our own capital that has been raised from accredited investors, like some of you on this call, that we lend out. And then we, for things that don't match our credit box, we will broker those out to capital partners all over the place. So it depends very much on what type of financing is needed as to whether or not we're doing it or brokering it out. We lend nationwide. It's strictly for business purposes. Just today, I had another person ask us for an owner-occupant loan. That's a full stop. We don't do that. If they're living in the property, neither us nor any capital partner we work with will fund that transaction. That is an entirely different business model. You need a conventional mortgage broker if there is an owner-occupant in the property. Our loans are to LLCs that own property. We're pretty quick. It takes us 24 to 48 hours, business days, to get you a quote on a property. And the actual closing time, people will claim, and you'll see this everywhere, they can close in 5 days, 10 days, whatever it's going to be. The actual time it takes to close most transactions is however long it takes to do the appraisal and get the report, plus about 10 days. That is a realistic closing time in most states in the country. We're not a bank. We fund deals the banks won't touch. We're doing the same fix and flips and buy and holds and multifamily and single family and commercial and industrial that banks don't necessarily like dealing with. All right, so it's a real simple business model to be a broker. That's somebody in your network. You guys are all out there and you all know people and you're all dealing with investors on a regular basis. Somebody in your network has a deal. If they need some kind of financing for that deal, you're going to go ahead and pre-qualify them, which I'll show you how to do tonight, and you're going to send them to us for a loan. When that loan closes, you will get paid. You will also get paid for any future loans that person does with us. So it's send it and forget it. You don't really have to work too hard beyond providing an introduction of a borrower who has a closable deal. All right, the pre-qualifying. Before you send somebody over, you want to be as sure as possible that it's going to close and get you paid. If you send over junk loans, it just wastes everybody's time. It's not going to work, and there's no cash to be had. So we're going to start with the borrower, also called the sponsor, also called the guarantor. It's all the same basic word. They're interchangeably used. We're going to start with the people behind the deal, and then we're going to look at the subject properties. So here's our borrower questions. For a single family, so these are for your 1 to 4s. So in lender speak, a 1, 2, 3, or 4 unit property on a single tax parcel is considered a single family home. The out-of-pocket costs, how much they're going to need to do that deal, whether it's a rehab or a buy and hold type project, is about a third of the purchase price plus any construction. That's not actually how much they need as a down payment. There's also liquidity requirements. They have to show so many months of mortgage payments, reserves, holding costs, all kinds of stuff. about a third is what it really costs, or what you have to have access to comfortably do the average renovation or buy and hold project. So first question for you guys is, where is this money coming from? If they're in a 5 or more unit, if they're looking at commercial stuff, RV parks, all that kind of stuff, expect the down payments to be higher, not smaller. So question number 1, where is your down payment money? What is it? Question number 2 is, what's the FICO score? If the FICO score is low, you just want to know up front so you can set expectations. If it's really low, there's going to have limited options. You're looking at lower loans to value, higher down payments, and higher interest rates. They can bring in a credit partner if necessary, somebody who's going to co-guarantee the loan with them and bring a higher FICO to the party. And third question we're going to ask is, what is their experience doing this kind of deal in this area? So have you flipped houses in this city before? Do you own any other rentals here? 0 is an okay answer, but it does, again, affect the options we have. So we're always going to ask for, where's the liquidity? Where's your equity coming from? What is the FICO score? And what is your experience? Okay, the faster you guys get this information, the more accurately we're going to be able to give a quote on their project. At this point, we take everything as declared. We don't care if they lie to us. All they're doing if they lied is wasting everybody's time, because it'll come up in underwriting. So we find that lying here doesn't do any good, so we don't need to check overly hard. If they tell us their FICO score is 800 and it ends up being 5, well, it's going to come out, and that's going to affect the offer on the deal. All right, what do we want to know about the property? Well, what are they doing with the property? Fundamentally, there are only 2 kinds of loans. There's a couple of variations on the theme, but there is either a construction budget or there is not, and it is a rental asset of some sort. So are they keeping the property as a rental? Are they fixing the property up? What are they doing with it? Fix and flip, fix and hold. That's where we're going to do both. A fix and hold is actually 2 different loans. We will do a construction loan up front so that they can do the repair, and then we will refinance that loan into a long-term buy and hold product. New construction is just a big fix and flip with slightly different math. Buy and hold is pretty straightforward. The major key is that the property has to be fully habitable and no construction needed. A rate and term refinance. This is where we get them a new loan, but the proceeds from the new loan only go to pay off any existing debt. There will be no money left over for the borrower. They're not getting any cash. And then a cash out refinance, which is a little different than your rate and term in that it's just a straight up, we do an appraisal and you take it usually as much out of there as you can or you want. And anything left over after paying off debt, the borrower will receive as a check, which they can use for whatever they want. All right, if they're doing a construction project, fix and flip, ground up construction, whatever it's going to be, here's the things we need to know. You guys will want to write this stuff down. We're going to want to know the purchase price of the asset. What are you buying it for? If you're not sure what you're buying it for, if you're still in negotiation, you're better off giving us the upper range of what you're willing to pay for it. That way the quote is as accurate as possible. Second question is, what is your construction budget? What are you going to put into the property? You got to know a number of what you're going to do there. And third, we're going to need what you think it's worth when you're done. So most of the time, an investor will run a comp package or have an experienced realtor give them that ARV. We're going to confirm all this stuff later with an appraisal. But for now, just like the FICO score, we take declared. Whatever they tell us is what we will go off of for the purposes of providing a quote. We do need to know the credit score. We're going to need the address and what kind of property is it. Single family, multifamily, commercial, industrial, ground up, whatever. Got to tell us that. We do occasionally get borrowers who are squirrely about giving the address. Usually that means they don't have the property under contract. The way I typically frame and deal with that is, I have no interest in buying your property. I'm only interested in lending on it. That's the business we're in. But you could encounter somebody, especially in your own local market, who maybe has had a bad experience before, and they have issues giving you the address. But we will need the address, not just a zip code, in order to provide a quote. All right, buy and hold. We still need the purchase price. We still need a credit score. We also need to know what the taxes are. We need to know what your insurance is going to be. The investor should figure out all this stuff in order to calculate whether or not the property that they're about to buy is going to be cash flow positive. So this is the stuff they should know already. We need the gross monthly rent. What is it either already rented for, or what do you expect it to rent for? Again, we're going to need the address and what kind of property it is, because these will very much change what our quote is. And then with buy and holds, are there HOA fees or other hard expenses that need to be accounted for in there? For example, is the current lease including utility bills that are going to be an expense? So might as well factor that in up front. It makes life easier. Otherwise, if you don't include these expenses and they come up in underwriting, then they could lower the loan amount, and suddenly the borrower has to bring more cash to closing than they expected. So it's best if we know this stuff up front so that the quote, the terms that we offer up front are as close as possible to what is still there when we close on the other end. We don't like changing the terms, but you got to give us accurate information if you want those terms to stay correct. All right, fix and hold. Fix and hold, like I said before, is two different loans. We're going to first have the fix loan, the renovation construction loan, and then you're going to refinance it into that long-term buy and hold product. So we need to know everything that we would need to know for both a buy and hold and a fix and flip. So this is your collect all the information one. So we still need a purchase price. We still need a credit score. Now we need a construction budget, because we're starting out by fixing it. We're going to need to know what the taxes are, or what you expect them to go up to. We need an insurance cost. We'll still need a gross monthly rent. What are you going to rent it for when it's all said and done? We need an address and property type, and we need to know if there's any other expenses. So it's all the stuff that you need for a renovation loan, except the after repair value, and all the stuff you need for a rental property combined. That's your fix and hold. All right, refinances. Refinances are typically, though not always, for buy and hold assets. So we're typically refinancing into a DSCR product or a rental loan. So they already own the property. We need to know when it was purchased and for what they bought it for. We're still going to need a credit score. We need to know the taxes, because this is basically the same stuff as a rental property. Insurance, gross rent, and of course, address and property type. And are there any other expenses that need to be accounted for? So a refinance is just a rental. It's the same questions, except instead of what are you purchasing it for, we want to know what you purchased it for a while ago. If they bought it and fixed it, they tell us what they bought it for plus how much money they put into it. So here is your pre-qualification script. Somebody tells you that they want financing for a deal. Question number one, where is their equity coming from? They're going to have to make a down payment of some sort. Where is that money coming from? Again, shorthand for you guys for both fix and flips and buy and hold properties. They need about 1/3. Can get it a little smaller than that, but generally it's about 1/3 to successfully and comfortably complete a project. So where is that money and where is it coming from? What's the FICO score? Obviously, the higher the better, but if it's low, we'd rather know now. Do they have any experience doing these types of transactions? Get all the relevant property info that we just went over. Then you just pop the deal into our deal form with your info as a broker, so we know it belongs and came to you or from you. And that's it, you're done. We'll reach out to them to collect all necessary documents. We'll provide the quote. And if it closes, you guys will get paid. We just handle the books every month. So the month following your closing, it'll get reconciled and you will receive an ACH. All right, loan constraints. So a lot of times if you tell somebody they can get a loan, they're going to ask you questions like how much can I get and what are the terms and all that. We prefer to quote it accurately, specific to their situation, because if you just start throwing out numbers and it ends up there's a variable you weren't aware of, that loan might not be, those terms might not be accurate. And people don't tend to react super well to that. So the best answer is we're going to get you an accurate quote, right? And so you guys should be aware that loans come with constraints. So the three major constraint types are loan to value. What is the size of the loan versus how much the property is worth in total? Loan to cost. which is of all the money you need to do this transaction, what percentage of that is going to be given to you. And DSCR, which is debt service coverage ratio, which is a way of calculating profit after expenses and debt service. Those are all ways that we use to reduce the loan amount or cap it. And usually, we're going to give you the lower of the constraints used. So even if you have a property that's, let's say you bought it for $50,000 and it's renting for $2,000 a month. So it's a very, very high cash flow property with an extremely high DSCR. You would still have the limits of loan to value and loan to cost. You would not just be able to get the maximum size loan from a DSCR. That's not how lenders do it. Another constraint you guys will run into, depending on where in the country you're located, is minimum property value. For most properties, this is about $115,000 for a buy and hold. And for a fix and flip, it's closer to $130,000. So if you have properties that are cheaper than that, most lenders won't touch them. So you're in a rarer niche of lenders, like our private fund at Always Capital can do the smaller ones. But that does mean they're looking at higher interest and higher points. So it's a different underwriting standard. So if you're below $115,000, definitely below $100,000 in property value, you already know it's not going to be the normal terms that you would quote. If the property is rural, then you're going to have a lower LTV, meaning that the borrower is going to have to bring a larger down payment. And commercial properties also have a reduced loan to value compared to singles. Single family properties have the best financing terms you're going to get. The further away your property or the asset is from being a single family property, the less favorable the terms are and the more equity is going to be expected from the buyer. All right, so here's your expectation with construction loans. Typically, you're going to see a quote that funds 100% of the construction. Whatever the project they're doing, we're normally going to fund 100% of it. Because if the project isn't complete, it's not worth anything as collateral. So whatever they need for a construction budget, they're going to get 100% of. On an average, and I need to stress, this is an average credit score, average experience, average location. A fix and flip loan is going to be about 80% of the purchase price with 100% of the rehab, up to a maximum of 70% of the after repair value, and 85% of loan to cost. So whatever the lowest of those numbers are, the LTV or the LTC, will be the cap. Those terms are going to be an interest-only payment for a year. Those are monthly payments. Interest rates run 10 to 14%. They don't tend to change very much. Interest rates would have to go up quite a bit for that to change. And you're usually looking at 2 to 3 points for your standard fix and flip loan. Ground up construction is similar to that. It's just the LTV is 65%. And when you're a borrower, they can think of buying the land as part of their down payment. So they should own the land and have it ideally entitled and ready to go. And then it's very easy to get the ground up taken care of. If they're buying new land, if you're looking at a large development or something, and they're going to do the horizontal development and they're looking for financing for that, we can do it as long as it also includes the vertical development, as long as it includes the ground up. Funding raw land where they're just trying to do horizontal is a different animal altogether and is a very special case. It's far more difficult, especially without experience. All right, rental expectations. So most of your DSCR loans on single and multi are going to be a 30-year fixed, and the rates are based on the market. That usually means you're 1 to 2% higher than whatever the headline mortgage rate is for today. So if you just Google what is the FHA rate is today, whatever it comes up at, you're going to be 1 to 2% higher than that on your kind of standard DSCR loan. The LTVs and the interest rates are way more sensitive to a credit score than we are in the fix and flip loans. You want the highest credit score you can get. 740 or better is going to get you the best terms. If you start seeing anything under 700, it probably means they're going to need to bring a larger down payment. So we want the best FICO score we can see on these. Single families, you can get up to 80% LTV on the purchase as long as the DSCR will cover it. Cash out refinances, You will rarely see them higher than 75%. Almost all of them are 75. Even the people you'll see lenders out there, they advertise 80. They very rarely close at 80. They apply some constraint and knock it down to 75. So you might as well set the expectation that 75% is the most you're going to get on a cash out. Multifamily and commercial are lower. You'll see them between 50% and 70%, depending on the asset class, location, and the personal financial statement of your borrower. Because these are longer loans, these are 30-year, they're going to be a lot more picky about who those borrowers and guarantors are because they're stuck with you for a while. So they want to make sure that those people are doing a good job. And if they don't look good on paper, then they're going to want a bigger equity position from that borrower to keep them safe. Debt coverage ratio minimums, they vary. You're between 1.1 and 1.3, depends on the asset class. For your 1.1s, that's a simple single family long-term rental. If you don't screw with it at all, that's the lowest they'll let you get. All right, there are products that are generally called non-recourse. These are loans where the guarantor doesn't matter. There's no personal guarantee associated with it. They're typically used when we're buying stuff out of a retirement account or if the borrower has issues. So if you have somebody come to you and they say, hey, I just got out of a divorce, my credit score, is 2 raccoons hissing over a McRib. It's like really low and not going to work. That's okay. We can actually do that. But they're going to be in a non-recourse only product. And typically the way those work out, you're at 50% loan to cost with a higher interest rate and points. Now, normally, the mortgage is so small compared to the property that the higher interest rates and points don't really matter. But expect that. And we can use it with those low FICOs as long as there's no fraud or mortgage defaults. So they're still going to pull the credit. They're just not going to care what bills you haven't paid or what you're late on as long as it's not anything to do with fraud or mortgage issues. These are super easy to do if your borrower has the down payment. So we are all for non-recourse. If you have somebody who can afford 50% down on an asset or wants to do a cash out refi at 50%, those are pretty easy to get across the finish line. So they're a great type of loan for us. All right. I know a lot of you guys do creative financing. So from a broker point of view, let's call it careful creative. You don't want to just do anything. You want to be very, very careful about how this works. Generally, the way that lenders look at creative financing is it's all kinds of various methods that are used to reduce or eliminate a borrower's equity in a deal. They don't want to have any cash of their own in it. This is a thing that lenders really don't like. It's best used to turn an acquisition into a refinance or as a bridge to refinance. As an example, I know a lot of you guys do subject to transactions. A subject to transaction creates what we call a technical default. So you violated the due on sale clause. You've sold the property, transferred the ownership without paying off the existing mortgage, and you keep it in place. That's what that structure is designed for. That can be okay as long as the property is cash flow positive and you refinance it into paying off that first position mortgage as soon as humanly possible. So if you're using it in that way, you're able to take down that subject to for basically nothing, just closing costs, hold it and cash flow it for 3 to 6 months, and then replace it with a nice 30-year fixed DSCR in your own name, getting that seller free and clear. So if they use it as a bridge to refinance and turn that acquisition into a refinance, that's actually okay. You can do that. But as a broker, you're not going to have any part of that until it's refinance time. These do increase the complexity of the transaction. Anytime we make the transaction more complex, it reduces the chance that it closes. Now, a thing that gets thrown around a lot is not to tell the lender. You just conceal it from them. If you don't conceal it, if you disclose what you're doing, it may mean that the lender says no or offers significantly worse terms. But if you don't conceal it, or if you do conceal it and don't tell the lender, then it creates a technical default. Almost every package of loan documents that you will get in the United States has some language in it that basically says, if this loan was issued under false pretenses and we ever find out that's a default, and the loan can be called due immediately along with penalties. So your borrower is putting themselves in that position. And as a broker, if you're knowingly doing this, you're putting your capital partner in that position. So be very careful with this kind of stuff. Loans that go bad do reflect poorly on you as a broker, even if the capital partner does the underwriting. If it comes out later that they have to foreclose on it and they find out that you were aware of all this creative stuff, it's not going to go great for you. Most of the major lenders in the institutional private lending space are part of an organization called the NPLA, National Private Lenders Association. Always Capital is part of that as well. That organization has a bad actor list, which you can think of kind of like the no-fly list. When we are doing a background check on anybody we're going to do business with, we cross-reference that list. And if the name comes up, that is a hard no across the whole thing. So you don't want to put yourself or any of your borrowers on that list. That is bad stuff. So I suggest being very careful with these things and disclosing it fully. At Always Capital, we understand you guys are doing that. We will help you structure it in a way that can work. It may not be the way that you thought it would work, but we can help you figure out some ways that will make it acceptable to a lender. There are certain lenders that allow a seller carry. Most of them that we know are full doc underwriting. So it will require tax returns and things like that. And a hard 10% down. By hard, I mean they want to see 10% of down payment come from the borrower, and those funds are verified as not having come from anywhere else. So that's the straightforward way that you can be allowed to do a seller carryback. All right, we do have a code of conduct for you guys. I mentioned this on the last class. We are happy to pay you. We want you to do this. We want you to do it really well, but we don't want you to be deceptive or sneaky about it. We want to shoot straight with everybody. We want to be honest. And we want to be ethical in our dealings. So these are our rules in our code of conduct. You got to follow them, or we will terminate your agreement with us. And anything we haven't paid you, you forfeit and you're done. You will not be a broker with Always Capital. Never lie or exaggerate about rates, terms, speed, or approvals. Don't go around telling people that we're going to close in 5 days and give them 100% financing and all that stuff. It's not going to work. It's just going to piss them off. And it creates a bad experience for everybody. Don't use the language of guaranteed approval. In this business, the word guarantee is a legal term. It means a promise that can be backed up and enforced with a lawsuit. So we don't say guaranteed ever, even the way our quotes are written and everything else. Until we have fully funded and the closing is completed, there are no guarantees. Don't do anything like bait and switch or spammy fake testimonials. No crappy, lying, weird, clickbaity ads. Don't behave that way. Don't pretend that if they don't get a loan today, they'll never be able to get a loan again. Don't do any of that stuff. If somebody trusts you with borrower information, things like their FICO score, addresses of properties, a personal financial statement, all that, just keep it all private. Do not share that stuff with anybody except who it's supposed to be shared with. If you are emailing and texting and that kind of stuff, there are the federal and state laws on spam and that kind of thing. You guys just follow those. Don't get in trouble. And stay professional. There is, I think most of you on this call are probably familiar with the Fair Housing Act because you're in real estate, where that says you're not allowed to discriminate on race, religion, sexual preference, family status, things like that. There's a similar thing for lenders. It's kind of the same thing in the mortgage lending space. None of those kind of discriminatory behaviors exist or allowed to exist. So don't do any of that. If you violate that stuff, we find out about it. We're gonna kill you from the program because we can't have that. Ultimately, while you guys are growing your own business, it reflects on us that we're your capital partner. So we will decide what's a violation there. We have no interest in doing this capriciously. We really don't. We want you all doing very well and bringing as many loans as possible. And I want to owe you a ton of money because that means we're all doing very, very well. But these rules are to protect all of us and keep our investor community ethical and profitable. All right. So If you guys are ready to start, you can head over to alwayscapitalllc.com/broker, where you will find a replay of the first class. And in a couple of days here, there will be a replay of this class as well. There's a little contact form for you guys to fill out. And what will happen when you fill that out is we're going to send you an email with a little media kit. It has a social media posts and a couple of emails and things that you can spread around to folks in order to attract and spread the word that you're able to get them funding for their deals. Starting, you have to give us till after Christmas. The lawyer hasn't got back to us yet, but we do have an e-sign document for you all that is basically just an e-sign on the code of conduct. So we'll have that go out to everybody. Once you have a loan that goes towards closing with Always Capital, the first time that happens, you'll get a phone call from me. I will reach out to you, and we will set up we'll need a 1099 and payment information so we know where to ACH your fees. So we handle that paperwork right about the time your first loan closes. So that is my contact info, and you'll see Mark's there as well. You guys are welcome to text either of us or send us an email with any questions. We will be happy to get back to you. Ultimately, this comes down to, if you're looking at a specific deal, we will need to quote it. And so we're not going to want to just tell you what the terms are because there's too many variables, and we would much rather be correct the first time.
There's a good question about, do we present ourselves as brokers or as connectors? If you want to talk about that first, I'm going to show the media kit real quick after you answer that question, because I think it'll be very valuable for folks to see it.
Okay. Okay, fantastic. Generally, I would just say you're a broker. Make it really simple. You guys are acting as brokers, and there's no harm in that whatsoever. There's actually quite a bit of more advanced framing you can do around being a broker. If you want to say you're a connector instead, that's fine. You're connecting people with money. It's all basically the same language. It's how do you choose to put yourself out there? At the end of the day, you're going to do the same thing. You're going to collect the requisite information. You're going to kick it over to Always Capital, and we're going to send back a quote. So however you get it there that isn't dishonest is fine with us.
100%. And you are not required to be licensed in any capacity to do this. You're simply referring information over. We're taking it all from there. And guys, what we find works best, and I've found this for years, ever since, oh man, I don't know, it was probably 2014, I think, they changed the affiliate marketing rules that required basically transparency in affiliate marketing. And this is more or less what this is. This is essentially your affiliate marketing to us in a way. And so be transparent. Let them know, hey, Always Capital is your capital partner. We're here to provide it. We're the second set of eyes on deals. We are the people that they can bring them to get the funding that they need. That's how we should be. Now, as far as presenting yourself, once you sign up, and we're still working on some details of this, but you'll get a link to this document right here. This is our media/promotion kit for brokers. Just kind of explains a couple of things right here, has some information. But over on the left-hand side, there's a couple tabs. One tab is going to be emails, and this is going to walk you through how do you create a copy of these emails for yourself. And then if you look through here, we've got a set of trusted partners emails, rate shopping emails, and speed to close emails. And we'll be adding more in here as we go along. And if you sign up to be a broker, we will let you know when we update this. These are emails that you can send to your list. If you've got an email list and you want to be able to let them know that this is something that you have now connected with a trusted partner on, all of these emails are here. In all of them, right, we highlight in yellow anything that you need to change. We'll have a referral link here. Actually, I should highlight that one, needs to be highlighted too. And then your name. So we just try to make it as easy as possible. These are, of course, written by me and my team. So they may not make sense, but they're a starting point for you. You can take them, you can tweak them if you need to. Again, as long as you follow the guidelines Brian gave, which is don't do anything crazy, dishonest, silly, stupid, whatever, like you're pretty much going to be good on that front. And then the last part here is this, which has actually a link to this Canva. I'm not sure if you guys have ever used Canva or not, but what this does is it will actually I'll take you here. This is a list over here. There's a whole bunch of different formats for posts you can do. And we'll be adding more as we go. Real quick on how to do this. A lot of these are designed as carousel posts. We find right now that carousel posts are a great way to provide a lot of information, right, in an easy visual format. So each of these start off by saying this is a carousel post, download each image after the IG carousel and go through that. When you create a copy, you'll get a full copy of this. You'll be able to actually come in here and make any changes to these that you want to. And we tried to put little sticky notes wherever there was things that you needed to change so that you wouldn't miss out on, putting that out there that way. You just come in once you change this information, you delete, you just click the little trash can here, delete it. You can do this all with a free Canva account. Everything we have in here should be 100% free. If not, you can always change some things in here, but it should be designed to be free for you guys to make it easy. And again, we'll be adding more in here as we go. So the idea is we want to give you guys as much as we possibly can to make promotion of this as easy as possible. And for you guys. Now, we'll also be building out eventually for everyone who signs up as a broker, a little broker site that you'll be able to just point people to that's yours so that everyone gets tagged back with you. And it'll go through the split, the if then of Brian's things like, okay, if it's a fix and flip, we need this. If it's this, we need this. So we'll be getting those all for you. We don't have them set up just yet. We should have it very early January for you, but it will be done then. So we're going to give you guys everything we can to make this as easy as possible for you to create a new stream of revenue in your business for something that everyone in this business needs. We all need money. I don't care what kind, like at some point, even if you're doing subject to deals with $0 down, your goal should be to refinance those properties as quickly as possible so that you have full control and no one can ever take them from you. You can't have some judge come in and say, "Oh, you did some shady stuff here. I'm giving it back to the seller," and you're like, "Oh shoot, what happened?" Right? And not that these are frequent things, but understand that if you control the money and it's in your name or you and your equity partner's name, you have a lot more options available to you. And that's what we're here to help you create.
I have a question on how you guys talked about a big fix and flip new construction. So I have a development already ready to go with the partner in Arizona. The county already accepted it and everything. You said ground up similar to horizontal. What does that specifically mean if it's a new development property? I was
So,
confused on that.
so when you have raw land, or
Mhm.
is it already zoned? Does it already
Yes,
the term is entitled? It already has its
it's ready to
utilities and all that.
go.
Okay,
Yeah.
then you're good. You're ready for a ground up loan.
Mhm.
Nothing weird about that. That's really straightforward.
Okay. So the ground up is that the same as the horizontal? That's where I was a little
It's
confused.
okay. So this is like developer lingo. The horizontal development is developing the land, so getting the
Okay.
entitlements and that kind of thing. Vertical development is putting a structure on it.
Oh, okay. Okay,
Okay,
that
so
makes
for
sense.
ground up, we want to do the vertical.
Vertical. Okay. Thank you. I
Okay,
appreciate that.
sure thing, sure thing. We'll be glad to quote that for you. Just throw it in, and we'll get you taken care of.
Great question too.
Okay, thank you.
I know you mentioned earlier that you don't need a license to do this, but I was just curious
Hmm.
because I am a licensed realtor and I work for a brokerage under a
Yep.
broker's license. Do I need to get like a broker's license for this, like an NMLS designation, or do I have to have permission from my brokerage to, you know what I mean?
If Yeah, great question. It's and the words are identical, but they mean totally different things. Real estate brokerage and mortgage brokerage, not the same animal at all. They're actually separate brokerage licenses and that kind of thing. The type of we're calling brokering that you're doing does not require any licensing. Effectively, we're the ones doing the lending, and we're paying you off HUD as a direct marketing fee. So it's totally cool the way we're doing it. There are versions of this business you can work with other capital partners and take it to a different level where you're having the uh, borrower sign a broker fee agreement with you. When you start getting into that kind of stuff, then yes, actually getting licensed as a broker in the subject state can be a thing. But the way we're doing it, you won't run into that.
And
So
one,
it's
one more thing to add, you get into more regulation as well when you get into owner-occupied loans. We don't do owner-occupied, it's only investment properties, so there's a little less regulation in that space, if you will.
Okay. Yeah, I was just kind of concerned because if I call myself a broker and then all of a sudden my
yep,
real estate broker, hears about it, then
yep.
he's going to start asking questions. And so,
If
Yeah,
you want to use the connector language, that's fine. If you just want to say I know a lender who can get this done, that's fine. It all works.
yeah.
Whatever way keeps you out of trouble.
One of the fancy ways you can say it as well is I have a great and trusted capital partner who can fund your deal, right?
Okay.
That's an easy way to say it. Avoids a lot of language. Should kind of keep you safe with your actual broker, and operate that way. And by the way, David, one other thing. Um, whenever you're talking to folks, we always find it's best to let them know that you are a licensed real estate agent. It adds to the credibility that you bring to the table. However, in this transaction, if you're referring a loan person to us, you're not acting in that capacity, but you do have your license. It
Right.
elevates you as a status symbol, but doesn't says, hey, I'm not doing the thing that requires a licensing activity.
Yeah, because I think legally I have to let them know that I'm a licensed realtor when I'm doing real, kind of touching real estate stuff,
Yep.
even though it's not necessarily, like you said, part of that transaction. So,
No, and you should
Right.
always own that. It's a huge credibility. Like people underestimate what getting your license will do for you, right? Even though, realtors get a bad rap all the time, but it's because most of them aren't doing the things that we're doing. But you still had to go take some classes, pass a test. You have an elevated level of knowledge over most people who have not done that. And so use that to your advantage.
perfect. Thank you, guys.
So I was asking about second position, but they actually said they were looking for 50,000 in first position and cross collateralized in second on a property in Chicago.
Yeah, cross collateralization can be fine. That's usually cool. And the way that cross collateral is taken is gonna depend on the specific transaction. A lot of times that is a second position, and they don't count it dollar for dollar. They count it as usually about a third of the actual value. So they'll want a lot of that. Another way to do it that can be quite attractive, especially if you guys are acting as brokers. So we want everybody to have clean paperwork, and we also like to get paid. So one of the cleanest ways they can do it, if they own a property that has a bunch of equity in it, you can get them to refinance that property, do a cash out. Now they get a big check, and they can do whatever they want with it. It's pure cash. So that can be a cool way to do it. You get two loans for the price of one.
Okay, so I'm just going to be upfront and honest. I don't know a whole lot about the financing side of things.
Mm-hmm.
And that's why I was kind of staying away from the weeds of the lending side. But I have this natural attraction for so many wonderful people that need opportunities, that have opportunities that need funding. I'm learning more about it, but
Mm-hmm.
I need more help, right? Understanding a lot of the things
Yep.
that we could do more, probably more than some of these other wonderful people in here, because I've talked to some of them and they know their stuff. So anyways, so that was my question. If that was something that you guys could do, something that I explained here, then I have someone that I need help with now.
That's fine. That's fine. You can just book a call with me on my calendar tomorrow, and we can go over the particular situation, and I'll quote it for you.
Okay.
Make it easy.
All right. Perfect.
I'll just tell you how to do it. We'll make it easy. You don't need to know.
Okay.
Yeah,
Perfect.
and this goes for everyone, right? Even if you don't have a ton of deep knowledge on how the lending process works, my recommendation would be don't try to say things you don't know, right? Because all it's going to do is it's going to burn the bridge for you with that person. Because either A, it's going to be a mismatch of the loan quote to what you said, which is the worst thing you could do, or B, they're going to go, well, that doesn't sound right at all, and they're going to go someplace else, and you've lost the opportunity. So the best thing you can do is just say, hey, I have a great partner. They will know all of those answers to those questions. Can I connect you? And then if you want to be involved in that conversation so that you can learn along the way, great.
Yeah, I
We'll
was just
how to
going
do
to
that.
ask for the link. Should I just have them book with whatever works with them? And I mean, I'll come in on it because my
It's
schedule.
fine. I just need honestly all we need. If the only concern from you is getting paid, the only thing I need is their contact info. I just need to know they belong to you because
Yep.
I need some
Oh,
method of
yeah,
knowing
like I
that
totally
they're yours.
trust them. Like, you
Yeah.
know what I'm saying?
Yeah.
I trust you
Yep.
guys and I trust them.
You can
And
just send us a
but I
text or an
don't
email
want
saying
them,
so and so
you know.
is booking a call with you because of me, and that's good enough. I'll be
Yeah, I
able to
want to
tag
be
it
able to
with them.
help them as soon as possible. And
Yeah.
of course, yes, it would really be nice to finally get paid. No offense.
Yep.
like I've tried to help people, and not that people haven't tried to help me, just deals didn't always go through, you know, for whatever reason. And like, I
Yep.
understand that. So this would be nice.
Exactly.
So,
This is
yeah.
this is pretty easy cash to get.
Yeah.
The biggest thing here, the number one reason we don't move, there's two major reasons we don't move forward with a loan. The first is it's not a deal in the first place. And when we look at this thing and come back to them, you're just like, guys, you should be buying this for half of what you're buying it at. It makes zero sense. Don't proceed, right? Get out. Yeah, just get out now. That's probably the single number one reason we turn something
Well,
down.
if I understand their situation a little bit, they kind of maybe lent on a property themselves, I think, and they had to take it back. And
that happens.
Now they have to fix it up and sell it or whatever they're going to do with it. You know,
we run a whole group dedicated to hopefully protecting people from that happening. So
yeah,
it's a thing though.
But yeah,
and then real quick, because this is important. When you guys bring us someone, as long like even right now, if you got someone ready to go today and we don't have all the things set up, just shoot us an email and let us know who they are and their contact information. We will make sure that that person is attached to you. As long as they do at least one deal with us every 2 years, they stay attached to you forever. So every loan they do, we're going to pay you on every single time. We're not here to try to steal your folks, or even if they come directly to us and they bypass you and they come right to us for the second loan or third loan or fourth or whatever, we're going to keep paying you guys because we understand that you guys are a marketing army that we can put into play for us, and we want you to get paid to bring us deals because everybody wins. They get the deal, we get the money, you get paid. They make more money. It's a win-win-win-win all the way around.
100%. And we started out as brokers. And that was our single biggest frustration was we would refer somebody to a capital partner. They'd do a loan with them. We'd get paid. Yay, got a check. And then that borrower started going straight to the capital partner and we're cut out. And that's it. So we got our little chunk of money and we don't get them anymore. So when we created the program at Always Capital, that was the number one thing that we wanted to change. We wanted to make sure that you guys got paid over and over and over again. So once you bring us somebody, as soon as they do a loan, they're yours.
I have a quick question. So a general contractor can be a loan applicant for a fix and flip or ground up construction or partner in the deal.
Yes. Yes, they can. And then their experience will count.
Okay, but if they sorry, I cut you off. If they are part of the building, are they able to apply?
Yeah.
Okay.
They're considered part of the loan application. They're going to be part of the ownership. They're going to be part of the LLC. Even if it's just 1%, they'll be on the deal. And they have to guarantee the loan, same as the sponsor. So when they do that, they're saying we're borrowing this money and we're taking full responsibility to pay it back with a personal guarantee. And that allows us to count their experience. They're involved in the project and they're on the hook to get it done. So that's why we count their experience. So yeah, it's a great way to do it.
Yeah, even though the experience is under a different business.
Doesn't matter.
Okay.
Yeah, that we can get around. It has to be the same kind of thing. If they've been doing home remodels or ground up construction for some other company throughout that same area, that's fine. We can generally count that. At the end of the day, we want to know that they know what they're doing in that market. So as long as we can be satisfied that that is happening, the experience will count.
And how they show you the experience?
A combination of ways, but the most common is a HUD. So we will actually see the purchase and sale of the property.
Oh, awesome. Thank you so much.
But to start with, they just have to let us know what it is. To get a quote, we just need a stated experience. We don't need the actual proof until we get further along.
Yeah, most of that is done today actually with AI. So there's a little form they fill out and AI cross-references it all. And only if AI can't do it, maybe because they're in a state that everything's non-disclosure and we can't see it, only then do we need to have them provide HUDs as proof. So it's just part of the document collection process.
Okay, awesome. Thank you.
Sure thing.
Kind of going off of what Kara was asking. I work with a contractor that has a lot of experience, but he happens to be like undocumented. Does that matter or anything like that?
They can't guarantee.
No. Oh, they can't. No.
Yeah, so then they can't count. They can't exist.
Oh, okay.
You know what I mean?
Um,
If we can't document them to put them on the hook for the loan, then it's which is kind of the point.
True. Okay, yeah, true. But but for hard money loan, if it's say if it's just myself getting a loan or just
Yep,
one borrower, and they're using somebody that's undocumented, and that guy can show you proof of his work and stuff like that. Does that hold any weight?
probably not.
No. Okay.
It's where experience it matters depending on the scope of the project. So if you're doing single family houses, quite frankly, you don't need it. It doesn't move the needle that far.
Okay.
With ground up, it's a bit more important. You start getting into multifamily, larger dollar amount projects, it becomes real important. Where the LTVs drop so much, it just gets brutal, and you might as well just pay somebody to get on the loan with you. So that's kind of where it comes in. But if you're talking about like single family or small multi assets, stuff under $1 million, don't sweat it. You'll be fine. Do a transaction or two, get your own experience, and use that.
Okay.
It's
Sounds
it's
good.
just that it's just where it really comes up is when you're doing the catch-22 stuff. You want to build a 20-unit apartment building, you've never done that before, and nobody will consider loaning on a project like that unless you have experience. So you have no way to get it unless you get a partner. That's kind of where that tends to come up.
Now, out of curiosity, when you talk about experience too, I've never done like a fix and flip, whereas like I bought the property, renovated it, and sold it like right away.
Mm-hmm.
But I've sold property, like I've been investing for 20 years and I've bought and sold properties at different points in time. And I've always renovated them like in various scopes too. Like I just did one that was like 50 grand when a tenant
Yeah,
left and then I refinanced it. So out of curiosity, if I came to you with looking for a fix and flip loan, like how much weight would that be? Like um
as long as the portfolio you're holding is in the same subject market, it will count. You'll be fine. The opposite is not true. If you're a fix and flip guy and you suddenly want to be a buy and hold guy, that doesn't translate. But we can certainly
okay.
take at least some degree of a buy and hold portfolio and turn it over because you're managing turnovers. It is part of it. It
Okay.
can count. Does that make sense?
Yeah, makes sense. Yeah, sounds
But
good.
but fix and flipping doesn't help you deal with tenants, so it
Yeah,
doesn't
right.
translate the other way so hot.
All right, thank you.
Sure thing, man. Did the stuff I went through for you guys with like the questions that need to be asked and the constraints on the loans to set expectations, did that make sense?
Yes, 100%.
Okay. Okay. There's a lot of variables, so I wanted to give you just the broad strokes of it. But the just you want to be able to set a general expectation, so they give you the necessary information to give them a real quote. Is really what it gets down to. How much do they need to know before they give you the necessary info that we can actually quote them and give them an accurate look at what's going to go on? Let's see. Question in the chat. What's the interest rates 10 to 14%? If they have a track record of doing flips for a couple of years ago, the flip interest rate is dependent on a combination of experience, FICO score, and the project. So it is the physical location of the property. It is the how big the scope is compared to the rest of it. It's whether or not that property is rural. There's a lot of variables to that one. You're probably, I mean, and the value of the asset is another item. So that one is really one that needs quoted. For most people, like if you're, I'm going to say a dead average first timer, you got a decent credit score at like 720 ish. You're and you have an okay amount of money. You'll get 80% of that purchase. You'll get 100% of that rehab. You'll pay 2 or 3 points, whatever it comes up as, and your interest rate will probably be around 12. You'll be kind of in the middle. Really experienced guys get it pushed down closer to that 10 range. They're almost always going to come out in double digits. In the off chance you do get a quote for one under double digits, it's like in the eights or nines, you'll pay more points to make up for it. So it really will end up in that 10 to 14 range, basically no matter what, because that's what fix and flip money costs. Okay. Do we lend in rural areas? Rural areas for single family, be rather specific here, you can usually make it work with a reduced loan to value. So it'll be a larger down payment. For commercial and multifamily, it's going to be a lot harsher. If the answer is not no, it's going to be a very low LTV because it's considered extremely high risk. If it's in the middle of nowhere, where are your customers and tenants? Doesn't make a lot of sense. So it's those are a little tougher to get across the finish line. Let's see. Are there states we won't lend in besides the Dakotas? Vermont is one nobody does. You've probably never even heard of anybody asking. Nobody does Vermont at all. I think it's their foreclosure laws. Is a big one. At the moment, certain zip codes in Philadelphia and the entire metro area of Baltimore are on the do not invest here, you'll lose money or be defrauded list. And that all changes in real time. So it'll probably be revisited again next year and see how they're doing.
Where do I go to see like the very first lesson and like the whole format? Because I'm just catching bits and pieces, so I start from the initial point, so I'm not lost. And like I'm catching back in.
Yeah, so you can just go to it's yep, Bell just put it in the chat for you, or Bob did. It's alwayscapital.com/broker. You will find a replay of the first class, which is a bit higher level than this. Gives you an idea of all this stuff, and then this one was this is the detailed one that I didn't touch last time.
Gotcha.
And for everyone's reference, we'll get this as soon as it gets edited up and cleaned up. This will be on that same page. And then Rick, on that page is a little form you can just fill out that lets us know that you're interested in becoming a broker with us. It doesn't commit you to anything. It just lets us know, hey, it's like a hand raise. Yep, I'm interested. So just fill that out after you watch that video.
All right, appreciate it. Thank you, guys.
I'm glad you guys brought up the video. I went out, filled the form, didn't see a video. Okay, I have to go back. But let me get to my question. Only
If it
me.
makes you feel any better, Florence, we added the video. It took a couple days for it to get edited and put on there. So it was added after you probably filled out the form.
Thank you, Bob. I like that. All right. Um, I'm a commercial girl, okay? And you were just saying how a commercial loan can be denied easily or
It's
or
no.
maybe I misunderstood.
Yeah, it's not. It's just they're different terms. So the terms on so commercial, it's actually a broad definition, is basically everything that's a 5 or more units,
Right.
plus like your industrial and office buildings and all that other stuff. So it's a real broad category. Within that category, we generally see a lower loan to value than you would in a single family house. So, for example, an office building, a default loan term on that is probably 65% of appraised value, as opposed to 75 or 80. So it requires a larger down payment to do the same things.
Okay,
That's
so
all that means. It's just asset specific loans, loan to values.
I understand. So instead of 20% down, I'd be looking at 30 or more.
Correct. Mm-hmm.
Ouch. Okay.
Yep. So when people say, okay, I want to buy a 100-unit apartment building for $10 million, fantastic. Please show me $3 million.
Okay, but that's not me. I want to buy a 10 to 50, and I want to buy it, like you mentioned to me, Pittsburgh. I'm looking at that. My thing is, it's kind of like I would never buy in New York. I live here and it's nice to look, but I would never buy here because it's not a landlord-friendly state, and
It's
there
true.
are so many other things that go along with that. But I'm looking at different areas, outside of my metropolitan area. Are there really friendly states for commercial? Because I find commercial is easier in terms of dealing with the day to day, but in terms of buying, it's not necessarily the easiest.
Yes, let me frame that just slightly different. You're
Hmm.
absolutely right that the state laws are a huge deal. Like you might as well write off everything north of Pennsylvania. It's not a northeast of Pennsylvania. None of those states are going to work out from a landlord point of view.
Hmm.
Um, there are some known really good ones.
Oh, really?
Florida, Texas, Ohio, and Pennsylvania are almost identical. That are generally considered
Okay.
pretty good as far as cash flow type laws go.
Hmm.
But the the question you should ask for your own acquisitions is what access to management resources do you have?
Yes, that's my
Okay.
number one thing.
Yeah, that's the thing. There's only one place
Management.
in the
Hmm.
country I could help with that, and that's Pittsburgh. I don't know anywhere else. I can't do it.
Okay.
So you when you want to identify is what are you going to do for management? And once you figure out, okay, I can get good management in this metro area, then you can buy there, and you'll be fine. If you just pick a place based on, okay, the laws in Texas are great, I want to buy in
Yeah.
Texas, but you don't have management resources, it is not going to be a great experience. It's not going to work out well. So pick the state in the broadest sense, but then identify good management. And once you've done that, then you can start looking at assets and what you want to pick up.
Thank
That's what I
you.
suggest you do there. Okay.
I really appreciate that because I've lived in California and I found the most wonderful management company and I wanted to use them everywhere.
Mm-hmm.
But I'm finding out they don't go to the East Coast,
Yeah, and
you know?
California, like much like New York, is very problematic from a buy and hold point of view. It's
Yeah.
a very difficult state for us to do business in. It's not impossible. People who do it, there's people who make money, but
Hmm.
it tends to be much more uh, uh, difficult from a management perspective than we see in other states. So,
Okay. Thank
okay.
you. Thank you for talking about management. It makes me feel better because I was so focused on that. Thank you.
Yeah, no, management's it. That makes or breaks it. If you got good management, you could buy bad properties and it'll still work. You could buy phenomenal property and bad managers will ruin it.
Yeah.
So it's the manager basically decides how it's going to work.
Okay. And I don't believe in managers. I believe in management companies.
Yep,
Because he can be in Zimbabwe with my with my funds, but I can find a management company. Yeah. Okay.
correct. Got to have good
Thank you.
management. Once you identify that, the rest is easy. It really is. It's not hard. You can totally figure it out because when you go through underwriting for the loan, we basically say, does this work as a rental property or not? So if you can't finance it, then you know it doesn't work. It's
Yeah.
really simple. The loan ends up being your second set of eyes, and the appraisal is your verification that you're not about to make a huge financial mistake. So it works as long as because there is an assumption that the management's going to be okay. So you want to verify that as an investor. Make sure management is solid.
Right. Right.
Okay,
Thank you. Thank
sure
you.
thing, sure thing. All right, let's see. Question from John. Can we go back in time to see experience from 15 years? Let me expand upon that. Yeah, we can see it. No, we won't use it. We don't care. The experience beyond 3 years ago doesn't count for anybody. Most of the time, we're only looking in the last two. I don't know anybody who will look before March of 2020. As far as we're concerned, that was a different era, an entirely different market, and entirely different rules. The moment they changed things for COVID, it was basically a new economic chapter in life. So I don't care if you flipped 1,000 houses in the 2010s. It's not going to translate to today's experience count.
And real quick, one sub point you had there is does credit score will experience offset a credit score? In most cases, no. There's everything's different, right? But John, more importantly, your past experience will not really offset your credit score right now, but your experience with us moving forward could. I won't say will, but it could, right? You could with us and you do, 5, 7, 10 deals with us, and we know you know your stuff and you're moving along, Great. Well, then it's going to become a much less of an issue because we trust that you are executing and your ability to execute matters more. It's not to say that it won't impact it at all, but it always will. At the end of the day, oftentimes whenever we see folks with lower credit scores, that's a great opportunity for an equity partner. Let them sign the dotted line along with you. It adds the value there, and it allows you to particularly if you want to do a lot of deals, it allows you to do more faster by doing it. Even if you're giving up a piece of the deal, doing more deals faster oftentimes outweighs that. So it's a way to look at that.
We talked about in the last class, we talked about the three primary things we look for in any borrower are liquidity, where's the cash coming from, FICO score, and experience. We can basically make a loan work the majority of the time if we have two of the three. So you can give up one and we can usually get across the finish line. If we only have one of the three, it's a bit tougher, and we'll usually recommend a partner of some sort. If you have none of the three, then you definitely need a partner. Somebody else is going to have to stand it up because you will not be able to personally guarantee. So that's how that looks. And John, from experience, it's the closer the asset you're dealing with is to a single family, the easier your life is. You can have zero experience and do a single family flip all day long. No problem. If you tell me you want to flip a 50-unit apartment building, I'm going to need to see some experience. So scale matters and asset type matters. But if you're sticking to the 1 to 4 unit stuff, it's a lot easier to do that. That's the best financing terms and the easiest stuff to get across the finish line.
So Brian, one of the questions Mac asked is, do we do loans on multifamily portfolios, mobile home parks, and RV parks?
Yes, all of the above, all day long. All the stuff, all the variables, Mac, that we already discussed apply. For example, RV park plus rural is a interesting challenge to overcome. So it's a very asset specific, quote specific item. But yes, we can do them. Okay.
And then how do you define rural? There's another question around that.
I think we put the magic link in here. You guys can check.
Oh yeah, the consumer finance link. Yep, it's there. I didn't see it.
Yep, it's there. It's in the chat for you guys. It's very literal. It's you can just pop the address in there, and that's whether or not it's considered rural. For the vast majority of lenders, that's gospel. Occasionally, you'll have some that'll make their own decision instead, but that's usually how we decide whether or not something's rural. Damien.
Hey guys, I have another question. So this is Philadelphia, your favorite city, but I'm working with two investors and they have 4 properties, right? And out of these 4 properties, they've been sitting on the market for like almost 180 days. And from what I know, one of them at least, because I was talking to her today, on one of them has hard money and private money. And I'm wondering, like, would you guys refinance that into a DSCR loan?
Specifically, normally the answer is yes, but you're in Philly.
Yeah, and it's also for sale too, because like sometimes the DSCR loans they don't like it when
they don't. They don't. Because when these loans are issued, give you guys a little macroeconomics lesson. When a 30-year mortgage is issued, we're not keeping that loan. Within a fairly short amount of time, us or any capital partner you would go to is going to sell that loan upstream. And it's going to end up as part of a bond security, mortgage-backed security that Wall Street or some insurance companies are going to buy. And so when they price these things out, it's with the assumption that you're going to keep it for at least 3 to 5 years, preferably longer. And that's why they default to having prepayment penalties. So almost every DSCR quote you're going to get is going to have a 3-year or 5-year prepayment penalty on it because they want you to keep it. When we start doing underwriting and we find out that the rental you're asking us to DSCR has a active listing, that's majorly incongruent from what we're expecting, right? So that is not fun. I haven't seen it kill a deal yet. I have seen it drop the LTV. Where they're like, oh, yeah, we were going to do a 75% cash out, but now we're at 60. So I've seen that. It's definitely not cool. If you know you're going to go this route, I would suggest pulling them off the market immediately and get them leased up. Have an active lease running on them. That's going to smooth things out.
Well, an active lease with a tenant or
Yeah, get them leased.
okay. Yeah,
Because
I'll mention that to her. She was gonna wanted to pull it off anyway, just to reset the clock for the days on
yeah,
market
yep,
too. So yeah, I'll throw that out there. Another thing that like maybe I want to ask too, because I said maybe this is a thing for her too, is that if she talked to both her private lenders and her hard money lenders and stuff like this, and because I said, why don't you offer, how we got into this is I said, why don't you offer seller financing? Because I looked at her listing and it didn't say anything about seller financing or rent to own options or whatever. And she said she couldn't do it because of private money and hard money on there.
yep.
And I'm wondering if you do this. And there's somebody else that does this strategy too, is they'll create like a wraparound mortgage. And then they'll tell the hard money lenders, they'll say like, hey, our intent is to get you paid off quickly, but we're selling the property. We're going to do a wraparound mortgage, and then we're going to sell the wraparound mortgage to a note investor. And from those proceeds, they're going to pay off, they're going to pay you off. Is that something that you would do potentially if just say if you did the hard money loan, and your borrower
Nope,
was stuck in that? No.
nope. I would absolutely refuse that because it strips away the collateral from my loan and leaves me with nothing but a piece of paper. So what I would want if that's the way they wanted to go, I'd be like refi me out, use somebody else. And
Okay.
everybody I know would definitely that I can think of would react the same way. They wouldn't like that. Now that said, the usually when this happens, you're sitting on a bridge loan of some sort, right? Like it was probably a fix and flip loan that's sitting there for a year or so, or
Yeah,
maybe
that's what
18
she
months.
has. Right. Yeah.
Yeah. So depending on the capital partner, they can be really cool about this, or they can be absolute assholes. So it kind of depends. One thing, like if it's our fund as an example, unless I have concerns about the asset, like I might insist that it gets reappraised. As long as we're getting our interest, I don't know that I care. We may be okay with it for some period of time. Others can get real salty about this, and they start charging a point for 90-day extensions, and you're paying that double digit interest. So it can get kind of nasty. So you got to look at that if you think that's a possibility when you're doing your rehab. In this case, it's way too late. You're into whatever you're in. But when you're looking at that, something to consider is how well will the note holder ultimately work with you on a longer term hold. They're definitely not meant to be held very long, but there is a big difference between, they're all written for a year. That okay, you can have 18 months for 1 point, and versus okay, I want a point every 90 days, and you're on default interest. So how nasty they get about that. Almost nobody will want it going past a year or 2 years. That's very dangerous. It usually suggests that it's way over leveraged.
Yeah.
So you got to be careful with it and think of it that way. The wrap thing, you could almost get away with doing it as part of a collapsed close, almost as in you line up the note buyer ahead of time. You have it all ready to go, and it all happens in a day. You might be able to do that and
Oh, like
make it look like a refinance closing. You're going to need the right
Yeah.
attorney. You're going to need all the right stuff, but
Yes.
that you might be able to get away with because the end result for a first position lien holder like me would be I'm paid and I'm out, and I still had my collateral until the day that happened.
yeah, most note investors don't buy like that, unfortunately. Like a
Yep,
lot of them want to get like at least one payment, best case three, best
that's
case
all right. So then
20.
not
Yeah.
to dive too far down this rabbit hole in the last 10 minutes we have. Uh, there's a lot of lenders who do that in sort of a shady way. They just
Hmm.
put 3 months of interest into the initial closing.
Oh, and they make the buyer pay it and they put it in an escrow kind of thing,
Yep.
right? And then
Yeah,
they
exactly.
pay it out like
That's
that. Yeah,
yeah,
I
that's how they do it.
somebody
And
did
as
that with
long
me actually. So
yeah.
yeah.
And of course it doesn't guarantee anything. And the other thing, most of your note buyers are going to be one of 70% LTV or they use LTI, loan to investment or less.
Okay.
So you need to make sure that you're below that number or get ready to stroke a check at closing.
Okay.
That's
Yeah, thank
that's
you.
how those will usually be looked at. But yeah, doing a wrap is it's a dangerous game. And most of the time, the loan documents are going to preclude it, so it would be a technical default. Let's see. Will I entertain a triple net deal with a fair purchase price if there's a strong tenant in place with a 20+ year lease? Yeah, mm-hmm. It'll be a DSCR purchase, and that'll be treated as the lease price, and you'll be able to show with a 20 year, we'll be able to do a T24 with no problem. So, yeah, we can absolutely use that to do a strong DSCR underwriting and quote it out accordingly.
Hi, how are you, sir?
Doing fantastic. How are you?
Oh, great, great. So I'm currently putting together like a TC slash Tupitor using this person's project to kind of help us guide that direction. But I was wondering, like, if the guy kind of volunteered to be my bosser for any kind of current somewhat. So I was thinking maybe if we like, I don't know. Sorry, it's been a long day. I just got out of the hospital.
Oh,
Yeah, if
wow.
they had like something else going on there, like what would that require me to have for them to well, I assume like positive credit score, all that fun stuff. Yeah.
Yeah. So it's the list I gave earlier, depending on what kind of project it is, right? I need to know, is it a new property? Is it existing property? Are we buying something? Are we or do we already own it? Are we keeping it? Or are we fixing it up and selling it? And is there a construction? And then we just
Gotcha.
need that associated information, and we can use that to quote financing.
Awesome. Awesome, man.
Okay.
Thank you.
Sure thing. Sure thing. All right. Let's see. Question from Lewis. What if you buy an investment property and it needs a renovation? Are you able to get a DSCR loan in second position? Does it have to be a seasoned investment property? Not quite how it works. If the property needs construction, you're getting a fix and flip loan on it, even if you intend to keep it as a rental. That's it. We call that a fix and hold deal. So you'll first get your construction loan. It's going to be basically standard rehab terms. And then once that's done, you'll finish your renovation. You'll pop in a tenant. You generally season them for about 90 days. Sometimes we can do it faster, but we kind of need a reason. There's no real need for you to do it that fast. You got a year to a year and a half. So usually we want to see 90 days of performance on those, and then we can underwrite that for a 30-year fixed DSCR loan on most asset types. Definitely all your single families and things like that. So a fix and hold is two separate things. If you want to go straight to a DSCR, then you will either pay for the construction basically you have to pay for the construction out of pocket, and the property already has to be occupiable. It has to, in a lot of jurisdictions, that means it has to pass for an occupancy inspection. So got to get it that far. Mac, for a triple net purchase, we still require a percentage of the purchase price. Yeah, it'll have an LTC constraint of some sort, depending on the asset class. So definitely expect that. It won't matter if it's a DSCR or 20. There'll still be an LTC cap. And yes, Mac, location will absolutely matter. It will affect it. It's one of those things that we'll just have to quote it. I'll need to know like where I'm talking about and what the underlying financials are to be able to give it an accurate answer.
Well, I'm new to this whole thing, but I wanted to get your sense. Should one operate as a limited liability when we do the brokering, or that's a whole separate thing? The sub
It's,
two, it is recommended to have a wholesale,
yeah.
and
So yeah, when if you're basically only doing it to us, it's just going to be a 1099. So you don't need much, and there's no liability attached to the way we're doing it. If you choose to go further down this rabbit hole of being a lender and doing more sophisticated brokering that gets into needing licensing and insurance and that kind of thing, and you're maybe even lending your own capital out, then yes, you're absolutely going to want an LLC to run that through.
Would this be a qualifying activity related to real estate? So for tax purposes, or
No, it's raw income.
no? So it's just like a regular well, not a W-2, but a 1099.
1099.
Subcontractor.
Yep. Mm-hmm.
Okay.
Yep.
All right. Thanks a lot.
Straight W-9 payment. Everybody you got your link to sign up as a broker. Again, it's not a commitment thing. It's just raising your hand so we know to email you stuff about this. All right, so preview for tomorrow. I will talk about Leia the loan bot tomorrow. That's it. So we have an AI can get you quotes and answer your questions. She is in beta, so if you guys want to play with that and see how well it does for you, and then let me know if it does anything super weird. We're very much still in the testing phase, but I will be playing with that on tomorrow's call. We'll give you guys a little demo of Leia. But if you have a deal today, if you want to get a quote out and hopefully get yourselves paid, or if you need a quote for your own projects, you just head over to alwayscapitalllc.com and hit the giant yellow borrow funds button. Once you click on that, it will bring you to here. If you are acting as a broker, I just click the broker button in the middle there for identity. And then I tell it what kind of project I'm going to do. Let's say I'm doing a cash out refinance of an existing property. So I'll just click on that. And here you can see all the options, all the different kinds of loans we can do. So let's do a cash out for today. And it's going to ask me all the questions that we need to quote this. So what's my existing loan amount? Let's just say it's 100K. We'll make it up. We'll say that the property is worth 200K. And we bought it back in the day for 80K. And let's say we bought it a couple of years ago. And we want to close, be realistic about your closing times. January 30th ought to get this done of next year. And let's say I am rocking a credit score of about 700. Okay. It asks you for a debt coverage ratio. Like what are you running at? Most of the time you should put in somewhere around 1.25. Okay. And then what's my rent on this property? Let's say we're getting 2K a month. And that means I'm probably paying some amount of taxes that are probably about 2,600. And it's a single family, so insurance is about 1,200 bucks. I'm in Pennsylvania. We don't do HOAs. Boom. And then I'm going to put in the property address of whatever that asset is. Just make something up.
$725 East Thayer Street, Philadelphia.
Yeah, we're not doing that because it would just tell me I'm disqualified.
Oh.
There we go. Sure, Wilkes-Barre. Sounds great. Okay, and then so you just pop in that, and then it gives you the map and the street view, so you can verify you've got the right address and that actually is the subject property you care about. And then we pop in the info on the borrower, whoever that's going to be. And you can give them a password if you want. I usually just set it to password because it'll tell them to change it as soon as they go to log in. If there's another borrower, you can hit yes, and you can put their info into, but you don't have to do that right now. And then your info as a broker. Who are you? Right? Optionally, you can tell us how you heard about us, which helps us out, but is not necessary. This broker piece is how we know that this loan came from you. This lead belongs to you, and when it closes, we owe you a check. And then deal description is just a note if you want to put one in, and then you hit submit, and it's off to the races, and that's all there is to it.
And Brian, are we having like updates how the process is going, and everything?
Yes. Yeah, great question. Great question. So when you put that in, it'll actually take you next to your broker portal because you actually pick your own username and password based on your email. And then you can see in that portal the status of all the loans you're dealing with. So every single one you put in there will have a status and what's going on. If you wanted to, You could help us collect docs and things like that, but we have a whole process for it. You don't have to do anything. So you'll just see what the status is. And once that guy shows as closed, you should be expecting an ACH from us at the next calendar month. We do the books monthly. So if it closed today, you'd be looking at a January payout. If it closed January 2nd, you'd be looking at a February, so on and so forth. So we just handle it when we do the books for the month.
So in the
Depending,
portal, it will show the documents that are required and how
Yep.
we, and then we communicate with you if we are able to collect those, or it's all on you.
we handle all that. You don't have to do any of it. If you want to do some of that, then yes, you can see the needs list, which is that's all the documents we need. If you wanted to do that, you could, but we have an entire system for it. That's our part. That's how we handle it.
Okay.
Okay.
And Brian, I think you answered this at the last Zoom, but can we both be the broker and the borrower, like refer ourselves if we're going to do a fix and flip or something?
Yeah, no double dipping. If you're the guarantor, you can't get paid on it. And I'll give you a reason why that isn't me being a cheap ass. It's actually, if we broker that out to a capital partner, it is a major no-no for the borrower to receive funds because of the transaction.
Okay.
So that's they don't want to see that in any form. So even if we like backdoor paid you, that would be going against the spirit of the agreements we have with them. So yeah, if you're a guarantor on the note, then you can't receive a broker payment for it. If you're a silent equity partner and a non-guarantor, totally different story. So it is a structure question.
Cool. Thank you.
Sure thing. Give you guys an idea. We make about 1%. We get 1 point when we make a loan. And we have to pay for things like, the lights and the software and the system that actually collected all the docs and all that stuff. So we have some expenses there, and then we need to make money too. So we're basically giving you guys half of the net is what it gets down to. So as generous as we can be. And then the cool part about it is, again, it's into perpetuity. So if they turn around and do 50 loans, you're going to get paid every time, even if they never talk to you again. We'll pay. We don't mind. It's just part of the books to us.
Gotcha. That goes a long way in the long run.
It does. It does. It can be it's a nice little business. You guys can actually end up doing quite well at it. And then depending, of course, it's based on loan size. So there's a big difference between you've sent over a $80,000 loan and you sent over a $20 million loan. Those are not the same animal. All right. And the paydays will reflect that. All right. If you need an immediate quote, let me know. We can get those in, and we can get those out to you before the end of the week here, and deal with any existing business before, because next week's going to be Christmas, and it's a bear to get things done during Christmas. So if we have any business that needs handled immediately, get those into me right away, and then we will go from there. We will get you guys Bob's going to send you out the media kits, and then we'll have the little e-sign document thing. Hopefully by New Year's, we'll get that done somewhere pretty close afterwards, but definitely before anything's going to close. So you guys will be okay. Reasonable closing expectation. There's almost no chance anywhere in the U.S. anybody's closing before New Year's at this point. It's just not going to happen. Even if we said we could do it as a lender, the title companies will be closed. Like, it's not getting done. So nobody's closing before New Year's. At this point, you're into basically late January is what I would look for as far as a reasonable closing date on something that was began now. Federico, the first webinar is the first class is on alwayscapital.llc.com/broker. Bell, if you'd throw that in the chat one more time so everybody can click on it. You'll find the first class there, and this one will get edited and put up hopefully next week. So you'll have these two side by side, and you guys can review whenever you'd like. If you have a specific deal, though, again, this is a quoting business. There's so many variables that the only way you're going to actually know what the terms are of a loan is if you did one in basically the same zip code in the last 2 weeks with the same kind of borrower. So otherwise, we're shooting in the dark a little when we tell what the terms are going to be. We need to have the details so we can quote accordingly. All right. Thank you, everyone. Great talking to you tonight. I hope everybody has a wonderful evening, and hopefully, I will see you on tomorrow's call. We'll talk about Leah the loan bot a little bit. We'll talk about some AI stuff and go from there. Again, if you have active business, put those deals in, or you can book a call with me, and we'll see about getting you those quoted before the end of the week, so we can get answers to you or your borrowers before we all go on Christmas vacation. So thanks everybody, and I'll hopefully see you all tomorrow. Good night.